All right, why don't we go ahead and get started? So, I'm Mark LaMonica. Thank you for joining. We're going to talk about the energy sector today, which has been in the news a lot lately for all sorts of different reasons, which we'll discuss. But first, our housekeeping items. Anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, get a copy of our FAP off of our website, morningstar.com.au. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. All right, so let's get started. We've got Emily hiding in the corner in the room today. She is very excited about energy, and today's webinar. She's giving me a very mean look. But anyway, let's get started. You can, of course, listen to our podcast, follow us on Instagram. But we're going to talk about the energy sector today. So we're going to give a bit of an overview first, and then I'm going to go on to our website and show you some of the different resources you can do if you are researching a sector, which hopefully will be good. But first, a little bit of an overview. So what we're looking at here is we're looking at the Australian energy sector performance over the past year. And you can see right here, energy is one of the few bright spots in Australia, and this is also true globally, in Australia and globally in the last year. So you can see we've got a couple other positives: utilities, which you generally see when markets pull back, and basic materials, and of course, energy. And one of the reasons, which we'll get into, obviously, that energy has performed well over the past year is that we've seen pretty big increases in energy prices. So when we're looking at the energy sector overall, what we're primarily looking at is producers of oil and natural gas and coal. So all of which have been in the news lately around surging prices, although they pulled back a little bit lately. But we'll talk a little bit about energy. But also the other important thing is not just focusing on performance, but focusing on valuation. So once again, this is looking at Australian, this is the entire market view, but what our price to fair value ratio is for each one of these. So once again, a price to fair value ratio compares what something is trading for, what a share is trading for, and what our analysts think it's worth. So anything below 1 is undervalued. Anything that's exactly 1, we believe is fairly valued. And of course, anything over 1, we believe is overvalued. So what you can see, we've got the price to fair value right now, and we've got it a year ago. You can see in a lot of these different sectors, including the overall Aussie market, we've seen it pull back as we've seen those market losses. But you can also see that energy a year ago was, by a fair margin, the cheapest sector that we covered. And right now, it is now tied for the cheapest sector we cover, along with technology. So even though we have done very well from a price perspective, we still consider it relatively cheap. And the reason for that, of course, is that a huge input, which we'll talk about a lot, huge input, obviously, into an energy company, into the profits they make, and into the value of the reserves that they have, is those underlying energy prices. So even though we have seen the sector do very well, we've also seen a huge increase in price. And that, of course, has driven those valuation levels higher as well. So still, at least now, tied for our cheapest sector. So let's talk a little bit overall about a couple points we want to make around energy. So the first thing is that the sector is very cyclical. So when we look at companies and we look at sectors, we measure, and one of the things we want to explore when we're looking at them is their cyclicality, or how much they are driven by changes in the economic cycle. So a highly cyclical company, their fortune is going to follow the economic cycle. A non-cyclical company is just going to continue to steadily go along no matter what's happening with the economy. So think of non-cyclical companies as companies that produce a lot of sort of basic needs, goods and services that people are going to need no matter what. So that could be companies that fall into, if we look at a sector view, could be companies that fall into the consumer defensive sector. that you're going to go out there and buy toothpaste no matter what's happening with the economy. Healthcare, because no matter what's happening, you're probably going to stay on whatever medication you're on. You're probably going to continue to, of course, go out there and treat yourself for things that are going wrong. And utilities. So basically these three are the non-cyclical. And then as we go up to the top, we see some of the more cyclical companies on here. So energy generally is fairly cyclical, and we've seen a case study in that in the past couple of years. So if we go back and we look at COVID, there was actually a month where oil prices were negative. And what happened, and I know that that sounds crazy, because it is crazy, but really what happened is there was a huge drop, almost a third drop in demand for oil during COVID. And it got to the point where basically all the storage facilities were full. And what that meant is in the futures market, when we're looking at future prices of oil, a lot of companies in the futures market is something that's also used, and it's not just speculation, it's used in real life. It's used for hedging, it's used by producers and consumers of oil. And basically a lot of the people that had these futures contracts for oil to be delivered to them did not want it because they had nowhere to put it, because basically all the storage facilities were filling up. So we actually did see oil go negative during COVID. And then as the world has come out of COVID and we've seen consumption go up, we've of course seen a surge in price. And those surges in prices of both oil and coal and natural gas have, of course, were initially one of the triggers of inflation. Now, the concern about inflation, of course, now is that it is beyond that, and it's gotten sort of embedded into consumers and embedded into salaries as well, and salary expectations. But a lot of that initial surge was driven by energy prices going up. One of the very important things to look at, obviously, whenever you're looking at anything like energy, is we want to look at the supply and we want to look at demand. So demand is generally driven by economic activity. So as the economy revs up, as I said, there's more demand. And then there's a lot of really interesting things on the supply side that make it very hard to predict sort of where prices will go. So one of the things about the supply side is that there are lots of different places we get oil, lots of different places we get coal, and the feasibility, the economic feasibility of extracting oil and coal and natural gas is very different across all these different sources. So a very simple example is Saudi Arabia has some of the cheapest oil in terms of their ability to produce it in the world. That they are going out there and, partially because the oil is so close to the surface, they have such large reserves that it's really cheap for them to actually extract that oil. Then, of course, we have more expensive sources of oil. So a lot of that is oil sands in Canada, because they're actually extracting that oil from sand, which is a very expensive process, and a lot of the fracking that goes on in the US. So both of those are a lot more expensive places to get oil and to get natural gas. And so what you see is you, of course, see different supply coming on and offline as those prices change. So when we had the sort of surge of oil prices, 10 years ago, something like that, when all of kind of that fracking or that coal seam gas is what they generally refer to it in Australia, when we saw that technology come out, you saw this huge surge in production in the US. And the US actually became, for a little bit, the world's largest producer of oil because of that. But a lot of those, as I said, are more expensive ways to extract oil. So when we saw that big price fall during COVID, basically they turned off a lot of those wells. But now, of course, you're seeing them come back online. The other thing that's really important, and that I'm sure everyone is pretty aware of, is there's a lot of manipulation of prices on both sides. So the most obvious side on the supply side is, of course, OPEC. So they are called a cartel for a reason. We recently saw OPEC come out and actually cut production to continue to support higher prices. Now, this angered a lot of people. It angered a lot of people because prices were still pretty high, and that OPEC cut drove them higher. And then this week, we saw President Biden come out and release more oil from the strategic reserve that the US has, which brought prices down a little bit. So on both sides, we're seeing a lot of manipulation. And we're, of course, seeing manipulation because on one side, a lot of the producers of oil, including some of the Gulf states and other producers, get a lot of their revenue from oil. They, of course, use that money for all sorts of things, but a lot of it's also for kind of social welfare to keep their population in line and happy, by giving them lots of money. So falling oil prices have a very significant impact on them. On the other side, of course, oil prices have a very significant impact on consumers. And so there are politicians in countries that are consuming oil that want to keep it as low as possible. So you've got both, different sides of that. The other thing going on, of course, are geopolitical considerations around supply. So there are a lot of oil producers and major commodity producers that are, a little bit pariah states. So everything from Venezuela to Iran to, of course, what we're seeing right now, Russia. And we also see supplies of oil and gas, not really coal, but oil and gas being used to try to manipulate other countries. So we're certainly seeing that now with Russia cutting off supplies to Europe. We saw that back during the Arab oil embargo. So basically, there's a lot of stuff going on, and there's a lot of different impacts on pricing. And we'll talk about how that translates from an investment standpoint in a second. And then the last bullet point, which we'll spend a little bit talking on, is, of course, ESG. So that stands for environmental, social, and governance factors. So a couple of things we want to look at with ESG. First, we'll get to the investing considerations in a second. But what is ESG doing? Well, it's doing two things, right? So, number one, there is a lot of pressure on reducing fossil fuel use. And what that is doing is, number one, it is restricting new supply coming online, right? It's restricting the ability to go out there and drill for oil in different places. It's restricting the certainly ability to increase supplies of coal. And it's also going after the demand, right? We've seen that in Australia. We've seen that with coal-powered plants being shut down before they were originally intended. And so you've got a lot of ESG considerations on both supply and demand. And we see it through investments in battery technology. We see it through the lack of permitting. We see it through a lack of funding. It's very difficult for a lot of these companies to go out there and get funding for new projects. So going out and trying to get a new coal mine built, permitted, it's a very difficult thing to do. And of course, those are all having impacts on prices. The other big impact that ESG is having is just from an investment standpoint. So while I can sit there and show you that we believe that the energy sector is very undervalued, a reason for that may be, and we don't know exactly what the impact is, but a reason for that may be, is that most ESG indexes either completely exclude the energy sector. So there are certainly examples of that we'll look at in a second, exclude the energy sector or dramatically reduce the companies that they're willing to invest in because they don't meet those ESG criteria. So ultimately, at the end of the day, investing, is about, we want more buyers than sellers. That's how we can get prices up. So as more and more of the world starts taking an ESG look at or an ESG lens when they are deciding upon where to invest, what companies to invest in, that's something that we, of course, can't not consider as an investment. But let's talk a little bit about sort of the investing side of things before we jump onto the website. So while oil prices are, and this is the Morningstar view, while oil prices are at a pretty high level right now, we do expect to see them retreat. So you can see retreat by around 30% by 2024. We do see a larger drop in natural gas prices. Now, there was a question about natural gas, about why there isn't a separate index for LNG. So I assume that you're talking about why there isn't a like investable index that you can go into. The only thing I'd say about LNG and say about sort of natural gas in general is, yeah, it's kind of a byproduct. Byproduct's the wrong word, but yeah, it's all part of oil production at the end of the day. So it's a lot of the similar companies have both oil and natural gas and liquefied natural gas as something they produce. So that may be a reason, but they have an index for everything. But a lot of these big companies, if you look at a company like ExxonMobil, one of the largest oil producers in the world, also produces a lot of natural gas. So that might be why there isn't one. The only other thing I'd say about natural gas is in general, and there's certainly a lot of infrastructure coming online to try to change this, but in general, it's a little harder to ship than oil. So you do see a lot of regional markets around natural gas, more so than you would for a pure commodity like oil. But yes, that's natural gas. One really important consideration for energy is energy companies are price takers. So what does that mean? Basically means, very simply, that they have to sell their goods that they produce for whatever price that commodity is trading for. And we contrast that with looking at companies that are price makers, that they are the ones setting the price. And obviously they have to look at consumers. But, very simply, if I'm Apple and I'm producing an iPhone, I am setting the price on that iPhone. And just like Samsung gets to set their price on their phones. So there's a difference being a price taker. And the price taker means, in general, it's a lot harder to have a moat, right? Remember, moats are about having this sustainable competitive advantage. Well, if I'm producing a commodity, it's a lot harder to have a sustainable competitive advantage. Really, the place that I have a moat or sustainable competitive advantage really is on the cost side of things, right? Like, it's very easy to sit there and say Saudi Arabia as a country has a sustainable competitive advantage with oil because they can produce it for so much cheaper than almost anyone else in the world. So we cover 136 names. Our analysts cover 136 names in the energy sector. And none of them have wide moats, and only 30 have narrow moats. So just something to think about. If you're investing in this sector, remember, we've got a lot of volatility. We've got a lot of cyclicality. We have a lot of companies that don't have that much control over the price that they're getting for what they're producing. Now, they can obviously take supply offline if they want, which we're seeing with like OPEC, but they don't have a lot of control over what they're selling that for. So what that leads to is high degrees of uncertainty or high degrees of business risk. Now, uncertainty rating is a rating that our analysts use, and they use it to assess their ability to estimate what's going to happen in the future. So remember, as any investors, we are looking at the future. That's all that matters. All right, it's the only thing that's going to drive returns. Doesn't matter what they did in the past, what a company does in the past. So as an analyst or as any investor, you're trying to figure out what's happening in the future. And the uncertainty rating, you can think about that as, that's really just like the amount of different or the variation of different business outcomes that can occur. And for these oil producers, for coal producers, a lot of that is around the price of the commodity. All right, so if there's a huge drop in price, obviously that's going to take a huge dent out of their profits, and vice versa. Certain point, obviously, any little bit that oil goes up is just giving more money to these companies. So only 12 of the 136 names that we cover have less than medium uncertainty, or medium or less, sorry, and they're all ranked medium. There's nobody low. So that means those are high uncertainty or very high uncertainty. So as an investor, if you look at all of this combined, if you look at the cyclicality of the industry, you look at the fact that they're price takers and they don't really have moats, you look at the uncertainty around the future business outcomes that occur, largely driven around those commodity prices, what you get a lot is you get a lot of volatility, right? So you're going to see prices bounce around a lot. And even going back to COVID, we can see that. We saw extreme falls in this sector. Obviously, as we saw extreme falls in the prices and demand going down. And then we've had a really good year this year where they've gone up. But there is a lot of volatility. So that's something that's really important to take into account as an investor. The other thing, and sort of we talked about the implications of ESG, and we'll get to the website in 1 second. We talked about the implications of ESG, but one of the huge implications of ESG is a lot of these companies don't really know what to do with their money, especially now when there's been this huge surge. So it's hard for them to invest, right? What you would normally see out of a commodity producer is high prices, big cash flows accruing to those companies. You would see them investing in more supply. That's kind of the typical pattern we see with commodities, right? And that's where a lot of that cyclicality in commodities happens, right? You have these huge investments in new supply. And then, of course, there is a bunch of new supply. And so prices go down. If you're a coal miner today, what are you going to do with your money? There's not a lot to do. So we've seen this surge in coal prices and these companies flushed with cash, and yeah, they just don't know what to do with it. And so what they're doing, because they can't invest in more production, because it's hard to get permits, hard to get financing for it. So what they're doing with a lot of this money is they're giving it back to shareholders through buybacks and through dividends. So even though maybe the share price appreciation is getting held back by some of these ESG considerations, their ability to invest in the future is getting held back from a lot of these ESG considerations, but they're giving a lot of cash back to shareholders. So we're certainly seeing that. And even on the front page of the AFR, right, it was talking about Santos today and just this huge amount of cash flow that they generated in the last quarter. So that's what we're seeing. So let me go into, well, first let's answer Lisa's question. So the very exciting thing is last Thursday, I got to meet Lisa because she was at our conference. I got to meet a lot of other people as well, but Lisa did not bring her out packas, but she told me yesterday she saved, it looked like a sheep. I'm not great with animals, but it looked like a sheep. She saved a sheep's life. And now the sheep's name is Lisa. So who knows? Kid goat. It was a kid goat, she says. Okay, sheep, goat. I think goats are more intelligent. But anyway, yeah, she saved a goat, and now there's a goat named Lisa. All right. So Lisa says, do you see current energy sector companies transitioning their product range into new green energy sources? We've got two questions now. Angelo asked the same one. Or will they, like camera film companies such as Polaroid, cease to exist? Yeah, it's a good question. It's a good question. I think, listen, do I think that oil is going to be around for a long time? Yeah, I do. I think there's no like real fast track way to get rid of oil. I think we'll see some of them invest in renewable energy. It's hard to tell, and maybe this is an unpopular opinion, but it's hard to tell if this stuff is just PR or if they're actually doing the stuff. And, you know, like Fortescue, I think is a really good example, obviously outside of the energy sector. But, you know, Fortescue, everything you hear about Fortescue is hydrogen, hydrogen, hydrogen. But, you know, they're not making money out of hydrogen yet, making money out of selling iron ore. Like maybe at some point it'll turn into a business, but it's also very difficult. If you're ExxonMobil and you've spent years and years and years doing one thing, it is very difficult to pivot that business. So yeah, I mean, maybe. I think that's an opportunity. I think what you need to think about as an investor is, will that work? It's very hard when a company has a lot of ingrained expertise to do something completely different. So yeah, one or two things could happen, right? Like if we saw this huge shift by these companies, not that I don't think all the renewable side of things will happen, but if it's by these companies, I think we have to assess their ability to do it, or whether they're just going to throw this cash flow and all this cash they've built up away on very expensive acquisitions. So yeah, I think as an investor, it's just something to think about. All right, so I am going to now share my screen. Of course, I'm never very good at this. There we go. So what I want to go through is just a couple different ways that you could explore energy. And I think there's two different things that we want to look at as investors. Number one, obviously, if you are interested in going out there and buying individual energy companies, there's a couple different things you can do to research. Obviously, you can go through and simply look at the companies that we cover. But if we go on to our global best ideas list, so this comes out every month. And what we can see, Australia is on top. So good place to start. We can go in and see, hey, are there any energy companies on our best ideas list still, even after this huge run? So in Australia, we've got one, we've got Woodside. Of course, you can read about why we like Woodside. So that's one thing you can do. And then if you want to look at a global perspective, we can just sort by energy. It's going to take me a little bit to get down there. There you go. You can see some of the different companies that are on the list from an energy standpoint. So that's one thing you can do looking at individual investments. But if you're not looking at investing in energy, perhaps you are someone who does not want energy in your portfolio, or you want to see how big of an exposure you have to energy, that's when it's good to look at some of these wide index ETFs. And we can see energy's overall exposure in, let's look at Australia first. We want to see how much of a overall market the industry sector makes up. So very easily, we can go on here and say, okay, let's look at the Vanguard Australian Shares ETF, and we'll see the impact that energy has on it. So what you'll find in Australia is Australia as an index, as a country, or as publicly traded companies in Australia, is actually overweight energy compared to, don't want to ruin this for you, but compared to the US or compared to the overall global market. So what we can see right here with sector exposures, see energy 6.66%. So that is higher than it is, and almost double what it is in the S&P 500 in the US, a couple percent, about 1.5% higher than what it is overall. But that's where you can see your exposure. So what you can see by this, even when we say Australia is relatively overweight in energy compared to other countries, it is still significantly lower than it is than a lot of other sectors. So I wouldn't call 6.66% a large part of the overall market, but Australia does have more exposure. And for those of you that hate energy and are very into ESG, maybe you're reading into this 666. What do you think? You think, Emily? She's rolling her eyes and shaking her head at me. But anyway, that was my Satan joke for the day. But that's energy making up the overall part of the market. The other thing, of course, we can do is use those same charts that I showed you. So I took, from a sector view, I took the sector performance, looked over a 1-year period and valuation. But you can also look at other markets if you want, and you can look at longer time frames. So if we go back 10 years, what are we getting in energy? Yeah, not a great annual return from an energy perspective. So that really encompasses some of those issues we saw during COVID. But you can also switch this to whatever other markets you want. Or in Australia, we look at North America and the US, we can go back and look at that same, go back to 1 year. Yeah, it's a huge surge, close to 44% in a year. Very good. And then if we look at a valuation perspective and say energy, yeah, doing a little better in the US than, or sorry, not as cheap in the US as some of the Australian companies, but we can look at that as well. All right. And then what I would also encourage you to do is go into those individual research reports, and those individual research reports will certainly put our analysts' views on where prices are going. But once again, when you're looking at those views of where prices are going, I would be very cognizant of the fact that most of these companies have very high uncertainty ratings, and that's because there's a lot of different things that can impact the price of oil. Even if we just look at potential outcomes in the war right now between Russia and Ukraine, will have a huge impact on the price of oil and gas. Whether we fall into a recession or not is going to have a huge impact on the price of oil and gas as well. All right, so we've got a question or a comment from Rodney. Rodney also met on Thursday and on Saturday at FinFest, the Equity Mates Conference, which was exciting. Emily was there and thrilled to be there. She's now not rolling her eyes, just getting very sick of me. So Rodney says, even if you're into ESG environmental investing, can't things like solar, wind farms, hydrogen, et cetera, appear under the energy sector, or is energy only fossil fuels? So I think two different things here. Most of those solar, wind farms, things like that fall into utilities. Because those are a lot of the companies that are actually producing them. If we go and we look at, and I'll show you, I'll go back and I'll share my screen. Here we go. So a good way of looking at what falls into a sector is looking at the industries that are in there. So basically, when we divide up the stock market, we divide it up into industries, and then we divide it up into, sectors, and we divide it up into industries. So if I do a filter, we can see this here. So I want to do shares. All right, so sector, we pick energy, and then we can see these categorizations in industry. So you can see we're talking about oil and gas and coal, basically, and obviously different parts of the oil and gas industry. A lot of that solar is going to fall into those utilities. And the very simple test. So what is this? It's ETHI, I believe. ETHI. What do you think? You think I got this right, Emily? All right, so if we look at this beta shares product, for example, so global sustainability leaders. Now, I will say that this product sort of takes a particularly aggressive is probably the wrong word, stringent view on what ESG standards are. So if I go into a portfolio on this, I can go in and look at what they hold and what they don't hold. And if I go and look at sectors, zero in energy. So yeah, a lot of these ESG, and what you'll see in some other ones, like some of the iShares, the BlackRock ones, you'll see a little bit of exposure to energy. But yeah, big zero there. So you certainly do see these ESG indexes completely avoiding the sector, which is kind of where we're getting into that problem from a demand perspective. But yeah, hopefully that answered your question, Rodney. Yeah, so it says, where would green hydrogen appear if it ever becomes viable, real, etc.? It's a good question. Like, right, they do obviously, they do update these industries as new industries occur, right? So, that could be an opportunity where maybe they will put it into energy. So that's certainly a possibility. But it's also looking at, if you look at Fortescue, for an example, if they start producing and start making money off of hydrogen, sort of the question is like, well, when do they stop becoming a basic materials company and they put them somewhere else? But so I would just say, Rodney, kind of a TBD there, or at least somebody smarter than me knows that. Yeah, so Lisa says Woodside's a great example of a price surge this past year compared to recent previous years. Yeah, exactly. Like, these companies that, basically were left for dead during COVID. And, these sort of notions that like demand would never come back, prices would never get any higher, like they all have done very well. I will say that, they were, a lot of them, things that our analysts said to start looking at, and that COVID drop was temporary. But it's kind of where investors, like, one thing I'd say is like, it was a good example of how investors like extrapolate into the future what's currently happening. And there certainly were a lot of investors who seem to think that this that what was happening during COVID and those demand drops were in fact somewhat permanent. And that as you saw more and more investment into things like battery technology and all these replacements for some of these fossil fuels, that they would just never come back in price. And yeah, basically the world opening up and Russia invading Ukraine sort of changed that whole dynamic. So it's just an example of the fact that we have no idea what's going to happen in the future. All right. Well, I think we've done it. Emily's ready to leave. I can mentally prepare for a meeting with my boss. But anyway, thank you guys very much for joining. Appreciate it. Hopefully you liked going through a sector. You can email me at mark.lamonica1@morningstar.com if you have any questions or complaints. And everyone think about little goat Lisa, who was saved and is now thriving, right? So we do have one more question from Craig. So Craig goes, what industry do battery tech companies sit in? I would say it depends, right? So like if you consider Tesla a battery tech company, that's obviously an automobile company. So what I'd say is a lot of these battery tech companies it's still not their primary line of business. So they're going to still sit within that company. Like Samsung is another really big battery company, but they're of course going to sit in consumer electronics because that's still what they are. So yeah, with a lot of this stuff, it's harder to find these pure play companies, is what I would say. But anyway, all right. Thank you guys very much. I hope you all have a great day.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.